Good evening, everyone. There's other people kind of still coming in from the waiting room, but let's get started because it's at 8:30 at least Eastern time. So thanks for showing up tonight. I'm Debbie Schwartz, founder of Road to College and the Paying for College 101 group, and I am here tonight with Luanne Lee of your college planning coach who Luanne and I have been working together, I don't know, probably 7 years. Just, helping to teach families about financial aid. And Luanne does one-on-one services for people in our audience who, want more extra help. So we've been doing this for a while. And tonight's topic, and I'll let Luanne introduce herself in a second. So tonight's topic is about what changes may be coming that are quite honestly kind of sitting between the House of Representatives and the Senate. And Luanne and I are just kind of under the belief that we want to share with people what these changes may be, and admittedly, they are not 100% yet, but it feels like there's no reason that we should wait until this is a done deal, because many of these things are very likely to go through, and you should understand what that means now, because it's going to impact your ability potentially to pay for college and aid that you might receive. Maybe it might not impact you next year, but it's a very good likelihood that if you're a parent with a student who's going into college in the fall, it is a likelihood it can impact you in sophomore, junior, or senior year. And quite honestly, the biggest impact, and not to scare anybody, is for the families with students who are graduating high school in 2026. You're going to be the first class that is going to have the brunt of all this newness. And then obviously all classes that are younger than that. So really important to understand kind of what's coming your way and what changes you could be making that could potentially help. So that's what tonight is all about. This is not political. I will say my one, and maybe you'll take this as political, but it's really just my comment is, if there's anything here that you disagree with, again, nothing is completely a done deal yet, so feel free to contact any representatives and senators and voice your opinion. But that's where we are right now, and Luanne and I just want to explain to people what these changes are, how it will impact you, maybe some ideas about how you can prepare yourself. So that's what tonight's about. Luanne, thank you for being here. Luanne is the bulk of the information tonight, and I'd love for you to share a little bit about your background, and then we'll get started.
Sure. Thanks, Debbie, and welcome everyone. And I promise I'm not here to scare you, but just to let you know how important it is to just be aware of the changes that are coming so that you can better prepare. So, I've been in this college planning world for just over 20 years now. And I started as a financial planner, just helping people plan, for their future and such. And at one point I was doing mortgages and trying to qualify somebody for a mortgage. It was a young couple, they were getting ready to get married. And I got to see credit reports for the first time. And I thought, what is all this Sally Mae debt? And turns out the young woman was in med school. And so, I sat down with them and I said, do you know you already have a mortgage? It's just in education debt. And she said, yeah, but I'm not in repayment yet. It's going to be several years before I have to start making payments, so it doesn't count. And that was my first real look, because we spent our years that my kids were growing up in Australia. So we didn't go through, my kids didn't go through the traditional college experience. I'm much older than all of you. So, this was the first that I got to see, wow, this is crazy. That's a lot of money that is going to have an impact on people's retirement. And then I learned that nobody was out there educating people on what to do about reducing that cost of college. And fast forward 20 years, here I am still doing it, but I decided to specialize my practice in college financial planning, because so many don't understand that college is a retirement problem. And the more that you overpay for college, the less you're going to have in your retirement, and the less that your kids are going to have in retirement.
And you know
So,
what, Luann? Actually, I always say, since I got into this space, that paying for college is the only financial decision that impacts two generations at the same time.
oh,
And
absolutely.
it's just what you're saying. It impacts retirement and it impacts the student's future financial capabilities.
Yep. Yep. And, you're trying to get your kids either out of high school or, just into college or such. And I'm talking about their retirement, so I know it sounds kind of bizarre, but the sooner that you start planning, the better. So
So,
we're going
yeah,
to,
Luann, let's just address this one question, which is, I think, of course, interesting. It's about Syracuse, and then we'll go into your slides. So somebody is asking, what do you think what happened with Syracuse could potentially help a family's financial situation? Waiting longer to accept, closer to May 1st, question mark. So for people, I think a lot of people know what happened with Syracuse, but the quick summary is that really right after May 1st, Syracuse started, they probably didn't meet their enrollment goals. They didn't have the yield that they predicted, and the yield means they send out so many acceptances, and then they predict of the students who they've accepted how many are going to accept them back, and their yield prediction was probably way off, so they didn't get the numbers of students that they were expecting to get, and so their enrollment was off, which is significant because enrollment's off for 1 year. It obviously impacts 4 years because you're not getting revenue from students that you would have wanted to for 4 years. And so what Syracuse quickly did, I think like May 2nd or maybe even some on May 1st, they started reaching out to students who had said no to them, and they upped their scholarship offer to students like significantly.
yeah, it was pretty deep. It was
Yeah.
good.
And then we even heard that they went back twice. Like they might have, like, either they didn't hear from a student and they went back again with another even deeper cut. So it was a big deal. It wasn't just a one-off here and there. They went to a lot of students, got a lot of attention. I don't know if you guys have seen that. Jeff Salingo wrote an article about it. Ron Lieber just wrote an article about it in the New York Times on Sunday. So anyhow, that's the background. The only reason I wanted to mention it, because to tell you the truth, I think what happened with Syracuse in a crazy way, and you'd love to hear your opinion, Luann, actually is not necessarily even connected to these changes that we're going to talk about tonight. They're crazy, which is not good. I think that they're separate. I think what we're going to talk about tonight can only compound and make what happened with Syracuse worse. But
Mhm.
but Syracuse didn't happen because of the bill. Syracuse happened more because of because their predictions were off, but also because of a fear of colleges, which rightfully so. Also based on all of the executive orders that have come through related to higher ed. The international students not potentially being allowed in, and a tax on endowment. So colleges we're seeing, shrinking enrollment, and they have what's called summer melt, which there's a natural kind of melt that might have happened over summer where students said, I'm going to come, and then they decline. So they sometimes lose a little, and so I think colleges in general obviously are getting nervous about their retirement. And then on top of that, Syracuse didn't meet their yield numbers. So I mean that's kind of what happened with Syracuse. And again, it didn't even I don't even think it factors in what we're going to talk about tonight.
No, I don't think so at all. They probably tightened up what they normally would offer because of, changes that are coming down. And, they're an expensive school. And so they had to backpedal. And they were not the only one. They were just the most prominent, I think. And this is typical for wait lists as well. I saw a lot of parents saying, well, geez, the wait list offer came in like 2 weeks after May 1st. Should I have waited? But that's just how the wait list works. You have to accept something by May 1st, or else you lose all benefit of any kind of offers that were made. And then if you are on a wait list, they will eventually maybe reach out, and then they expect you to answer, say within, 48 hours. And, some parents are saying, we haven't even visited yet. They don't really care. They've got a whole list of, hey, if you can't answer this, next, because the college's job is to fill the seats. And, but I never even gave it a second thought that what was going on with Syracuse had anything to do with the loan changes and such. I think the biggest thing, my biggest concern is to make sure that the offers that were offered are renewable.
Yes.
And, what's the criteria for keeping those offers? So that's,
And when you say offers, you're talking about the scholarship dollars that
correct,
Syracuse
correct.
gave. Yeah.
Yeah, yeah. So, because, you have to read that fine print, like what we were talking about earlier today. And, everybody's so excited about the acceptances and whatnot, they don't go any deeper. So,
So, okay. So
all right,
now
you want to get
on
going?
on to
Okay.
loans and financial aid.
Oh, yeah, fun stuff. Okay, so our agenda for tonight is pretty simple. We're going to talk about these changes that are coming up, who it's going to impact, especially the 2025 college freshmen, and why I say that. High school seniors and younger, definitely. And what we're calling like the new era in college planning. It's something that I've done forever, which is plan when you're, looking at these schools and the costs, so many are thinking, oh, we'll figure it out. Let's just get in and then we'll figure it out. And, or we've got money for the first semester, maybe for the first year, and then we'll figure it out. We'll get an RA position or scholarships or whatever. And, that's a wing and a prayer. You've got to put a plan together and a full 4-year or 5-year projection to say, okay, how are we going to manage this? And with these changes that are happening to the federal loans, it's going to be more imperative than ever to look at that long-term planning. So again, like Debbie said, we're not trying to be political. We're just trying to make you aware, because I'll be honest, I did a lot of CSS profile reviews last year for a lot of families. And these were not my private clients where, I'd worked from them from the beginning through to the end. And so it wasn't my place to say, wow, you've got a lot of expensive schools here that really don't give much in the way of merit or such. I, of course, still made those comments, but, they'd already made their decisions and already had applied. So as all these changes are coming up, I was really starting to worry about a lot of these families that I know this is going to be a big stretch for them to accept some of the schools, because they're trying to give their kids the dream school that they're, oh, you work so hard, you deserve this and whatnot. But so many families, they're going to start borrowing from the first year. And with these proposed limits that are going to be happening, many of them were just planning, and maybe many of you that are listening, were planning on using the federal Parent Plus loans because it's easy to get It's not as stringent as some of the private lender loans. But now, even as I'm talking with my private clients, we are looking at a really complete different strategy for paying for college than just thinking, okay, we're going to just use the Parent Plus loans and use the income driven repayment plans or whatever, because all of that is changing as well. So the Senate and the House, they have both, and will show, what their projections are, their proposals. And so now we're just waiting for them to finalize all of this and decide what they're going to agree on, what they're going to compromise on. But so those final figures are not going to be, accurate as far as tonight is concerned. But you need to start thinking about that long-term planning as soon as possible. And I'm just going to say, for some of you, that after this evening, if you feel that your student is going to fall into that category, that going off, excuse me, in the fall, and you don't know how you're going to manage this, it's better to have okay, should we really have a heart-to-heart discussion with our student? Because I'll tell you, the worst thing, and I get these calls from people that I've never met before, that, my student is in their sophomore, junior, going into their senior year, and we've run out of resources. And this is going to make it even worse, I think, if people are not planning ahead properly. So, okay. So one good thing that we think is going to happen, because there was a lot of going back and forth, oh, this is going to change on for 2025. They pretty much have all agreed that the earliest that this is going to take effect is going to be July 1st of 2026. So, that's a good thing. But we're going to have that side-by-side comparison, the importance really of, that pre-planning. You're going to hear that oh my gosh, so we read that the Parent Plus loans and the Grad Plus loans are being eliminated. Yes, the Plus loan is probably going to be eliminated. It's just going to be replaced with whatever limits that they have. And so it's going to have a new name. So Plus is definitely going away, both for undergrad for the Parent Plus loans, as well as for grad school with the Grad Plus loans. Private loans are going to be a little more prevalent than they have in the past. Back in 2008, when the stock market was tanking, the real estate market was tanking, I mean, we had almost 100 private lenders decide to shut their door to education loans because they said that's the next big bubble and we're not willing to take that risk. And that's when the government stepped in. We're going to make sure that students can still attend college. And that's when things started going a little bit skewy with, unlimited federal plus loans and such. So just be aware that, with private loans, they're a little bit more stringent with their underwriting they are looking at credit scores, debt ratio, just your financial health. And even though with the Parent Plus loans, they're still going to run your credit, but all they're looking for is to see, do you have any late payments on any creditors? Do you have a bankruptcy that's open? And do you have any federal tax lien? Because of course it's a federal loan. So if you have any of those things, you would get denied the Parent Plus loans. So, I've had people that have had a 600 credit score, they're not working, They're not earning any income, but they've got, they have no dings on their credit, and they've been able to borrow Parent Plus loans, which is half of the problem that we have right now with the trillions of dollars of debt that we've got. Okay, so there is talk about changing the Pell Grants, which I think is horrible. We had finally gotten it up to 7,395, which is still not much for families that have lower incomes and such. Now they're proposing, the one is proposing, instead of having Pell Grants eligible for part-time students, to do away with that, and you have to be a full-time student, 15 credit hours per semester, which is going to hit a lot of students that use Pell Grants to go to community college. They're also talking about if they approve between the two of them, the House and the Senate, there's the possible elimination of another grant called the Federal Supplemental Education Opportunity Grant. And that is for those folks that do qualify for the Pell Grant because they are the neediest of all, and they can get an additional supplemental grant. And so hopefully that's not going to be eliminated. Now, when the FAFSA Simplification Act was rolled out a couple of years ago, there were a lot of changes that happened. And one of them was, prior to that, if you were under a certain income level, you did not, it didn't matter, I'm sorry, prior to the FAFSA Simplification Act, everybody had to report their assets, whether you had $1 in your checking or savings or $100,000. It didn't matter what your income was. FAFSA simplification came in and said, well, if you are under a certain income and you qualify for receiving some federal assistance like food stamps or Medicaid or such, then the parent didn't have to disclose their assets. And that helped to what some people refer to as Pellionaires, where, maybe you've got monies sitting in assets, but your income is low enough, it's not going to trigger that you have to disclose those assets. So they're saying now that they want to go back to everyone has to report their assets no matter what their income level is. And one of the worst things that they adjusted with the FAFSA simplification is, prior to that, if you had a small business, family-owned business, or a family-owned farm, you had less than 100 employees, and you did not have to disclose your business assets of your small business or your farm, your family farm as the business. So then when they put the FAFSA Simplification Act in, you had to disclose that, which I thought was just terrible. And we've been trying to fight it for the last several years. And now both sides are agreeing that needs to be removed. So I'm hoping that when we are filing the FAFSA in the fall of 2025 for the incoming class of 26, 27, that may not be a question on the FAFSA. The issue that I have is they don't make these changes on these forms very quickly. So if the question is there, is it not going to be reported? It's too early to tell yet, but I'm hoping that that's going to be off the FAFSA, and especially those people that are out in the Midwest that have farms and they might only pay themselves $30,000 a year for a family, but yet they've got a couple $1 million in machinery and equipment and such, and they had to show those assets, which definitely, put them out of any kind of aid situation without having to write appeals. So it was a mess. So the summary of the proposed changes, and this is just for undergrad right now. And we have a slide at the end that breaks this down even to more degree. But basically the House is saying we want to get rid of the subsidized portion of the student loan and just have unsubsidized. And the Senate is saying, no, we'd like to keep the subsidized loan. So they've got to come to terms with that.
And Luanne, maybe just explain, because it could be families here.
Yeah.
What unsubsidized versus subsidized means.
So subsidized means that the government is paying the interest. It's a subsidy that they're paying the interest on that loan so that the interest is not accruing for the student until they've graduated. And it is a form of financial aid. Everybody disagrees, but it just is what it is. The federal student loans are financial aid. Everybody can, as long as they file the FAFSA, can receive unsubsidized loans. And those loans are, interest is accruing from day one. So if you qualify for financial aid, then, and you get a portion of that subsidized loan, it's, you're not having to pay the interest. And I saw a discussion in a thread the other day where, people were saying, well, but, I received a subsidized loan and we don't qualify for any financial aid. Well, actually you did, because if you received a portion of a subsidized loan, you're the cost of attendance minus the SAI from the FAFSA. If there was a gap, then that school could make up some of that gap in aid in the form of a subsidized loan. So hopefully that won't go away. Currently right now, we have an undergrad loan limit of $31,000. So if your student graduates in 4 years, they can receive a total of subsidized and or unsubsidized loans. The total would be $27,000. If they go longer than the 4 years, and I apologize if you can hear my dog whining, in the background, I'm trying to ignore him. But if the student goes another year, because, the national average is showing students are taking 5 to 6 years to graduate with a 4-year undergrad degree. So make sure you put that in your plan as well. But they're able to get an additional $4,000. And so that's the max of the $31,000 for an undergrad dependent student. An independent student can get up to $57,000, but we're not going to get into there. But also, if the parent was to apply for a Parent Plus loan and get denied, then the student can get an additional $4,000 each year that happens in an unsubsidized loan. So what the House and the Senate are proposing are, the House wants to up the limit for the unsubsidized, or for the undergrad limit to $50,000, and which I think it should have been changed a long time ago to put a little bit more emphasis on the student and less on the Parent Plus loans. The Senate is saying, no, let's keep it the way that it is. So, they're going to have to come to some kind of an agreement. The Pell Grant, we discussed that, there probably is going to be changes. the Parent Plus loans is the big one. So right now, currently, there is no limit per se. You can take the cost of attendance of a school minus any of the either federal aid or institutional aid that you received from the school. And whatever is left is the maximum that a parent can borrow in the form of a Parent Plus loan. So what they're proposing is to put limits. And I mean, these limits are pretty extreme. It goes from, on the House side, a 50,000. So we've heard three proposals. 50,000 for the family limit. So if you've got,
Regardless of how many students, of how many kids you have.
correct, or 50,000 for the student per or 50,000 for the parent
Per student.
per student, or the House, or I'm sorry, the Senate is saying, well, they'd like to put it at 65,000 and cap it at $20,000 per year. So they're going to have to, again, come to, it's going to be something between that 50,000 worst case scenario and that 65,000, which will be a limit for that parent, but they're also going to cap it at $20,000, or suggesting that they would cap it. So that means that if the student loan is still, let's just say that stays at where it is right now.
It's really like 28,000 if you're going for 4 years.
Right. So, as a freshman, for those of you that are not aware, a freshman can only receive $5,500 in the federal student loan. And so then if they've borrowed their 5,500 and the parent gets capped at 20,000, I've seen people that are borrowing 30,000 plus. So again, you have to be aware of all of these internal things to see is this going to be an affordable school for us? Do we have to reassess? And then, currently there's no accountability, there's no financial liability to the colleges for all these students that are graduating from college and they've got a degree, but they're not getting a return on investment. They can't find jobs or whatever the case is. And so they're proposing to put some sort of accountability on the colleges, and suggested that it's going to be like earnings based. They're going to look at the major and see, well, from this particular school, let's just say, and I'm going to pick on Cornell because everybody's been picking on Cornell lately, but let's just say it's Cornell. And for some reason, people that got an accounting degree at Cornell cannot get a job, which is crazy. So I'm just being facetious here, and they start going into default on their federal loans. So now the government is going to run those numbers and say, well, geez, all of your, a great deal of your graduates that went into accounting and they're not getting jobs and they're defaulting on their federal loans, we're going to either they're going to get fined or have some financial consequences. So, it's fun times. Now, loan repayment and forgiveness changes, there's going to be a lot, and believe me, it's very confusing. I'm not going to get into the depths of it tonight because that's also something that is, hasn't been confirmed or decided on, but there's major changes that are happening. We've gone really off the rails with federal borrowing and going into income-driven repayment. And I'm not talking about public service loan forgiveness. That's a completely different topic that really doesn't fall into all of this loan forgiveness that everybody's been complaining about. This is the loan forgiveness that somebody can't qualify for public service loan forgiveness. And they're going to, they took on a lot of debt. They're not earning enough income. And so their payments are going out, and there's like 12 different plans. It's very confusing, but anywhere from 15, 20, 25 years, then they'll be forgiven, but there's huge taxable consequences. Your interest keeps accruing. And that's how, you know, you hear about all of these. How can an undergrad student who can only borrow 27,000 have, you know, a $300,000 student loan debt? It's more on the grad students, med students, Parent Plus loans. That's where all of the majority of these larger loan balances that you're hearing about. So the government is going to reduce forgiveness, and both sides agree with this. So they're actually coming up with what I think could be a fairly decent plan. It's just going to depend on how much that you have to repay. And they're not going to be, the interest that you end up not paying is not going to accrue, which is huge. So, you know, there's not going to be those taxable consequences. So they're agreeing almost on that. So that will be coming up sometime this year. So why plan now? I mean, you know, with these loan caps, whether it's going to be 50,000 or 65,000 over the 4 years limit, you know, I see a lot of families that they want their kids going to these $90,000 a year schools, and they're thinking we're just going to have to make this happen, and we'll worry about it later. You have to start worrying about it now, thinking about it now, planning about it now, because you don't want to get to the point where you're going to be calling me in your junior year of college to say, Luanne, we've run out of resources and we can't get any more federal loans. Our debt ratio with the federal loans that we took is too high for us to get private loans, or maybe a private lender is going to take that risk and charge you, you know, 18, 19% interest. It's not worth it. So that's where, you know, you're going to have to start really taking the emotion out of this whole college planning journey, and use more, just be more, you know, people call me the voice of reason, because I don't have any emotion. I'm not tied to this. And I can help find, you know, to find out, you know, this is really too expensive, or maybe we need to look at some other options. You have to start thinking about that. So my concern for the 2025 high school graduates this year is if families are going to be borrowing, and I'm not the loan police. You know, I haven't met too many families that don't have to borrow something. But again, you just have to do it within reason. But my concern for these 2025 families is that they're going to, maybe by the time they get to their junior or senior year, they're not going to, they'll be out of resources, and their student is going to have to take a gap year. And we hear about gap years all the time. Of course, that's the beginning gap year. They're not ready. They're not mature enough. We need to earn more money. But that gap year, if you have to, your student has to stop in their junior year of college, the likelihood that they'll get back to it is unlikely. And then 6 months after they're not in school, then the loan repayment starts. Whether you took federal loans, private loans, the student direct federal loans, all that repayment will start. There's no degree. They're working, part-time jobs or, at Starbucks or whatever. They're not earning the kind of money that you would have expected them to earn when they graduate. And it's just going to be, a vicious cycle. We don't know, also, if, let's say, the class of 2025, by the time they're ready to go into their senior year, they're talking about a 3-year runway. So we're going to have like a 3-year period where those that are in college right now, and that includes you, rising college freshman families, you're going to have some leeway to get through these changes. But so then in the senior year, that's when you're going to get hit with this. And we don't know yet if, let's just say that you've been taking federal loans, if in that senior year, are they going to be counting those balances at that point? Or is it just going to be fresh for you to say, okay, you still have a, $20,000 limit if they say, you're limited to $20,000 per year, or will you be able to have that unlimited so that you can finish, up to maybe 50,000 or such. So, thinking about if that's going to be the case, that you're borrowing from day one, you might want to reevaluate, take a look at the private lender loans that are out there right now. And we've got a slide with some rates and such to share with you. But, sometimes you'll be surprised that the interest rate might be a little bit higher than the federal loans are. For years, everybody is complaining, oh, the federal loans, they're so expensive. The interest rate is so high. How dare they charge a fee? And now that they're putting limits, everybody's complaining, how dare they force us to go to the predatory private lender loans? We can't have it both ways. But, sometimes we think, oh, geez, that loan is 1 or 1.5% higher in interest. I'm going to go with a lower interest rate. You might have to adjust your thinking in that regard if you feel that you're going to reach that limit with the federal loans and start off with the private loans, even though in some cases the interest rate might be higher. For some of you, the interest is going to be way lower. But so everybody is different. And, somebody mentions, oh, I got a 3.5 interest rate with Sally Mae. And you're thinking, oh, wow. Or I just got my student loan and I'm so relieved that that's done. What interest rate did you get? You see all the posts. It doesn't matter what they got, because their credit score, their debt ratio, their financial health is completely different than yours. So you just got to be aware that everybody's going to be different. So those of you that maybe...
Oh, sorry, Luanne, somebody is a little confused. She's saying she heard you say about the 3-year runway, but the 3-year runway would start next July 2026, right? So, but okay, I realize why she's confused. The 3-year runway only applies to students who are going to be college freshmen this fall and other students who are in college. So it doesn't apply to the class of 2026 of high school.
Correct.
Okay, yeah. So because she was asking and saying, I have a rising high school senior, will the 3-year runway affect me in junior, senior year? Honestly, unfortunately, as a rising senior class of 2026 and younger, the 3-year runway it's not an option for you.
And to be quite honest, I don't even know how they're going to manage that, to have, you've got those that are in the old system and now you have these that are in the new. They don't do tech very well. We saw that with all the FAFSA fiasco. So it's going to be interesting if they're going to do it this way. But honestly, I hope that they do that and give a little bit of leeway for those that are in college right now. And that includes those of you that your kids are starting as freshmen in the fall. You're considered in college right now for this discussion. Because, if they're not given that runway per se, kids that are like right now in their sophomore, maybe they just finished their sophomore year, they may run into problems for their senior year as well. I'm talking in college. So, but if everything starts July 1st of 2026, then yes, the rising seniors, high school seniors that are going to be starting college next fall of 2026 are going to be, all of these changes are going to be implemented. And so as you're looking at your building your college list, affordability is going to be even more important than ever. Don't get enthralled with the prestige of the Ivies and such, unless you are very low income and can receive a lot of grant assistance from those schools. So, I had a client this year, twins, both got accepted to Princeton, and their out-of-pocket cost is going to be less than $1,000 for each student. Yet there were other schools that they got accepted to that would have expected them to pay $70,000 a year. So it all depends, but they still have to get accepted. So, so college selection, you've got to look at your debt for the next 4 years, or how you're going to pay. And, no longer can we just wing it year by year. There's going to be a much larger increase in using private loans. So there's going to be a lot more private lenders, like Debbie and I were talking today. More credit unions are going to be coming out and offering educational loans, where a lot of them had stopped giving them for a number of years. So it's going to be interesting. So I think we already talked about all of this. We're unclear how the limits are going to be for those starting in 2028 yet. Private loans, you've got to be aware of the underwriting. So those of you with your kids are just starting high school, hopefully there's some of you listening. Now is the time to get your financial health in order. Clean up your credit. Really start tightening your belt and trying to save as much as possible. And, you don't have to put all of your savings for education. You've got to save for your retirement as well. So don't shortchange that. But if you can start doing things, picking up a, second job or such, early enough, not just waiting until, you get the financial aid award in April of the senior year and you're trying to figure out, well, how are we going to pay for this? We expected scholarships. Start that planning early enough. So college selection, number one, there's, scholarships. So many say, oh, looking for third-party scholarships is such a waste of time. It's not, if you have a system and you start early enough. And your kids have to start doing things early enough to warrant receiving a lot of those scholarships. But a vast majority of the students that don't get any scholarships is because they didn't follow the directions. It's really systematized and it does work. Is it a lot of work? Yes. It's a lot of work, it's a lot of effort, but the earlier you start, the better. And if your kid isn't going to be putting in that time and effort, and you can't help them because you're working a full-time job and taking care of your family, then, get your kids out and help them find part-time jobs earlier in high school so that they can start saving and helping towards this. Grants and ROTC, you hear so many people say, well, you should look into ROTC. All of that needs to start early in the planning. Students know that they're possibly interested in ROTC as early as freshman and sophomore in high school because there's so much planning that goes into that. We've talked about the federal loans, the private loans, and I can't believe I'm saying this, but, we're even going to be looking into the 401k loans. It's always been the last resort for me when I'm talking to families, other than credit cards, of course. But if it's going to make a difference between your student being able to finish their senior year, that's when I would look at whether a 401k loan is going to be appropriate, not just in general. And home equity, everybody, they start screaming, how could you even think about that? Just, put blinders on like a racehorse and look at things very strategic, not emotional. Sometimes, when interest rates are lower, that could be a good time to, to take out an equity line. I heard on the news briefly tonight, mortgage rates are going up again. So might not be a good option to take an equity line. We don't know. You got to do that deep planning. Those of you that have, whole life or index universal lives or variable universal lives where you've got cash value that's built up, that's a great place to borrow from. You're borrowing from the insurance company, not from yourself, but it's not going to show up on your debt ratio. It's not going to show up on your credit report, and you have some flexibility in those repayments. So there's going to be a lot of really deep dive looking into how are we going to structure out the 4 years so that we can get our kids through this. And, picking up a part-time job or the side gigs, I hate that word gig, but, something that's going to fit into your lifestyle. A lot of people like multi-level marketing, and just as many people hate it. Find something that's going to help you generate some extra income, and, start a little part-time job, babysitting or dog walking or whatever. Now, I've got a couple of examples to show you what I mean by college list and planning. So this scenario, 200,000 income, $100,000 in assets, and this is software that I've used for a number of years that is usually pretty accurate. And they have a college budget annually, 28,000. They're going to take the student loans, the dream school, Berklee College of Music. As you can see, it's fairly expensive, not as bad as some of the Ivies and the schools that are in that 90,000 plus range. But you can see here, they don't give merit scholarships. And this institutional need-based grant, sure, they gave a little bit. So the secret sauce to all of this formula is you take the cost of attendance of the school, and you're going to minus up in the left-hand corner, that federal first year SAI, Student Aid Index. That's when you file the FAFSA, and they do the calculations on your income and assets and how many are in your family and all those things. And they come up with this number that says, well, that's about how much you should expect to pay out of pocket. And when they changed the FAFSA Simplification Act, it made it simpler for people to know if they qualified for Pell Grants or not. So in this situation, this family doesn't qualify for a Pell Grant, but the SAI, as much as everybody says it's just an index, it's not a number, it's no different than what the expected family contribution is. Cost of attendance minus the SAI is going to equal the need or the gap. And how is that school going to meet that? So the secret sauce to that is some schools are going to meet it at 100%, which means they're going to make up the difference in the gap. And some schools are not going to meet it at any percent. And then some are, somewhere in the middle. But then you want to know how much of that gap is going to be met in grants, which is free money, or how much of it is going to be in self-help, which is in loans and work study. And that's the secret sauce that you want to know so that you can figure out, well, how much is this actually going to cost us? So in this scenario, it's showing here that even though this family has what, $112,000 set aside for college, they're still going to have a gap where they're taking loans of almost, $160,000. And so this second arrow here, that is, let's just say that it was, it was all in one loan. And so you'd be looking at like a $1,800 a month payment for every month for 10 years. That's the standard 10-year repayment. Or you could stretch it out for 25 years, but you'd end up paying like $100,000 more in interest. That doesn't make any sense. And this estimated monthly take home is just taking an average at that school of what someone has earned, a 1-year grad, 5-year grad, and 10 years, and they average it out. So many parents are saying, well, this is my kid's journey. I'll go ahead and co-sign the loans for them, but they're going to make the payments. So can you really think that a student that might be bringing home, less than $3,000 a month and paying rent and utilities and their car payment and everything else, are they going to be able to make a $1,800, $2,000 a month payment? No. So if you co-signed for that, eventually you, the parent, are probably going to end up having to make some of that payment as well. So if you're not able to make that payment now to the college so that you don't have to take loans, what makes you think that you're going to be able to make those payments in 4 or 5 years from now? Now, the next scenario, same student, same family, except this is Goucher College. So this is a Maryland, was a Maryland example. Same major. It's just not the dream school of Berklee College of Music. And their gap, instead of 160,000, would be, 30 to 40,000. And even at a $400 a month payment, the student could manage that, so that the parents aren't taking on that burden, or they can split it or such. But those are the kind of things that you have to take into consideration as you're building your college list and taking the emotion out of it, because believe me, your kids will thank you when they're older. They'll hate you now because they can't go to their dream school. But once they get to wherever they're going, they're going to love it by the time the spring break hits. And they're really going to be thankful when they don't have as much education debt after they've graduated. I hear it all the time because I work on the other side of the fence. Once people have graduated, I help them figure out what kind of income-driven repayment plans or public service loan forgiveness. I'm a certified college funding advisor, and nobody is happy with their debt. And they all say, I wish I had taken a different route. So these are an example of student private lender loan companies. These interest rates, this slide is probably 3 to 6 months old. These interest rates are changing on a daily basis. I've seen some recently 3.5 to 17%. It's all going to depend on the terms. So, somebody says that they got, a 3.5%, and then maybe you went and they're giving you 11%, and you're thinking, why is there such a difference? Again, the underwriting of the lender, but also it's the terms. So with the private loans, and just like with the federal loans, you can start repayment right away. It's just with the federal loans, everybody gets the same interest rate, which right now, the federal Parent Plus loan is just under 9%. The student loan is, just under 6%. They just announced the new rates. I should have written it down before I started tonight. But with the private loans, let's just say that you're going to borrow $20,000 and you tell College Ave, I would like to start my repayment once my student graduates, because after all, I'm just co-signing for them. This is going to be their debt. And they say, sure, let's go ahead, process the application. And they come back and you've got maybe a 740 credit score. Your debt ratio is not so bad. And they come back with an 11% interest rate. And you're thinking, what the heck? Why is this so high? Because you've told them you're not prepared to make payments right now. Whereas you're borrowing $20,000 and you're telling them, I want to repay this from day one, and I want to pay this in full in a year. Of course, they're going to give you the best rate that they're showing. So it all depends on your terms and what you can fit into your budget. So, it's a new era because we're going to have to start thinking about affordability more than admissions, more than the importance of getting in. It all blends in together, but the affordability piece is going to be harder for more families if they were always planning on borrowing. And I'm not talking about, again, the federal student. I think every student should have that 27,000 of the federal student loans. It builds character, makes sure that they, show up to those 8 o'clock classes instead of sleeping in. But, and it takes some of that burden off of you. I cannot stress enough how many families I end up talking to that are in their 60s and they're carrying over $100,000 or $200,000 of Parent Plus loans, or even their own education loans, because they went back after, maybe 10 years ago or so because they had a job loss or downsized or such. It's not pretty. And I will say that, there's been talk in the news about garnishing Social Security wages for defaulted education loans, and that is not going to happen. They are not going to garnish your Social Security wages, but they will garnish your tax return if you're still working, and many of these parents are still working because they've got these loans, and they can garnish your wages as well. So my concern is, that lack of planning. We might have more dropouts than ever. And you have that opportunity to plan earlier and try to offset that. And I think that there's going to be a lot more of you're going to hear people talking about 2+2. So students that are going to go to community college and then have reciprocal agreements like what we have in Virginia here. to transfer to a Virginia state school and complete their degree. There's a lot of work that goes into that to make sure that that is an easy transition. It's not just a simple thing of, yeah, I'll go to community college for a couple of years and then I'll transfer to my dream college. Oftentimes, the classes that they took at the community college are not going to be a seamless transfer. You have to work at it. You have to look into it. I've had plenty of families that have done it, but that, again, that planning starts early. So,
So when somebody's asking, can you do like a 1+3, 1 year at community college and 3 years?
sure you can, but is it going to be beneficial? I would look into why doing it that way. Because oftentimes, at least if you've gone the 2 years at community college and you've at least got the associates, it makes it a pretty, and again, if you've done the legwork beforehand, you know what you're transferring into, it can work real well. But to go for 1 year and then go into a university, you may end up still having to spend 4 years at that university because you didn't plan it out accordingly as far as the classes that they know that they're going to accept for the degree and such, if that makes sense.
Mm-hmm.
So this, screen up there, I'll just leave that up there, Debbie, while if there are any questions in the chat that you want answered or such. I'm just looking at, if you see the line that says RAP repayment plan only, that's going to be the income-driven repayment plan that they're discussing will be probably the main one. Hardship, unemployment deferments, they are both Senate and the House are saying, no, we're not going to accept that anymore. A lot of those deferments, people going into forbearance, you could put off your repayment for 3 years, but all that time the interest was accumulating. And that's where these loan balances were just getting so sky high. But that's, that's after you've graduated. One thing, for those of you that are considering your kids want to go to med school, I cannot stress enough the importance of affordability for undergrad, even for those of you that, hey, you've got a robust savings and you've done really well and you want to give your kids that opportunity, that you've worked so hard to do that. Wonderful. But with these limits that are coming up, the limits are going to be on grad school, med school, law school, and such. Don't you think that you could be better position your kids to really be firm? Hey, we don't have to go after the big name prestige and such. Let's be more affordable in the undergrad years, and we'll have a chunk of savings left over that we can help you then with your grad school, with your med school, with law school, with veterinarian school. Every other girl in Virginia that I meet wants to be a veterinarian because they all like horses. Dental school. I mean, they're all so expensive. And with these federal limits, it's going to be very difficult. And I can foresee a lot of private loans. And of course, the parents are going to be co-signing into retirement. So,
Quick question about 529 funds. There was a question which I answered, but we can talk about it. Can they be used to pay back loans? And also, can 529 money be used for grad school?
so yes, it can be used for grad school. And yes, you can use it to pay back loans, but a lifetime limit of $10,000.
Mm.
So that's it. So if you've saved up enough that you have some left over and you don't have other children, let it sit there for a while until you figure out if your kid is going to, go on for any further education. Maybe you want to do some education. You could use it. And if not, you can transfer up to, what is it?
3,500.
35,000.
35,000, sorry, yes, yeah.
But that money had to have been there for at least 50
5
or more
years.
years.
Yeah.
And, there's a lot of, rules and regulations around it.
Can you clarify whether financial aid considers tuition being paid for siblings?
Say that again.
Can you clarify whether financial aid, like the, formulas, consider tuition being paid for siblings? Like, is that part of their calculations?
As far as the FAFSA counting, taking into consideration more than one student.
Sorry, I'm sorry.
So,
Yeah.
so no longer when you file the FAFSA, you could have 3 kids in college, your SAI number is not going to get divided between those 3 students. That changed with the FAFSA Simplification Act. There are private schools that will still take into consideration, you've got multiple children in school, especially if they're at other private institutions. So they will take that into consideration. I just don't know how long they're going to continue to do that. Because remember, the FAFSA simplification was only 2 years ago, Debbie.
I know.
It seems like a lifetime ago, but it was only 2 years ago. So I foresee, that these schools are just going to eventually just peter out and say, okay, we got everybody through, and now we're going to go along with the FAFSA and just look at, per student.
So parents here don't necessarily realize, but about 2 years ago, there was changes to the FAFSA calculations, the formula, the software. So that's what Luann's referring to. You kind of missed all that, which is good, but just, think about it from the college perspective. They have been through a lot, which you don't necessarily know about. So they've been through a lot in terms of delays, dealing with the government. This is, before even this particular administration change. They've had to adjust their aid calculations or their aid budgets, and now of course they're going to have to reevaluate them again, and so it's been a lot on colleges.
Yeah, I really felt for the people that were working in financial aid the last couple of years.
I think it's actually been the highest, like in the college space. It's one of the highest areas with the highest either retirement or people leaving.
Yep. Oh, it was. I remember reading something about it. It like 70% or something were considering changing departments and or retiring.
Yeah.
It was a mess.
Yeah.
Still is.
So I think, Glenn, you answered a lot of questions. I've been answering them in the chat as well. Oh, someone says it's been a lot for parents too. Completely agree.
Yeah.
Our first college student was in that mess 2 years ago. I completely agree. It was a mess for everyone. I'm the parent of a rising senior. How would you complete the FAFSA based on 2025 income? You wouldn't complete it based on 2025 income.
So the FAFSA, so rising senior, you're going to file the FAFSA in the fall. Now, typically it opens October 1st. I don't see any reason that it shouldn't open October 1st this year. The last couple years, there have been delays while they were rolling out the new FAFSA Simplification Act. So sometime in October, you do not have to stay up until 12:01 and get your application in because somebody told you they're going to run out of money. That doesn't happen. So give yourself a little bit of breathing room because every year, everybody rushes, it crashes, they have to fix things and whatever, and you don't want to get stuck in that. So wait a week, wait 2 weeks. Just make sure that you look at the deadlines for each of the schools that your student is applying to make sure that you're going to get everything in by those deadlines. But so you're going to be filing in October of 2025 for the 26-27 start of college freshmen, which means you're going to be using the 20, what is it? We're in 2025.
2024.
2024, I'm sorry, prior tax return. So you're going in for year 26, you're going to be using the 2024 tax return. Years ago, it was very different. Now, what they've done where we're filing in October, late in the year, the majority of people have gotten their taxes done. They're in the system. It's going to be a simple transition online that you authorize the IRS to send your tax return to FAFSA. You don't even see any of it done, which confuses a lot of people when they're doing it. But for anyone that's younger here, the base financial planning year for the FAFSA finishes on December 31st of your student's sophomore year in high school. So you have that year to maybe put more money into your qualified retirement, because that's going to drop your AGI. Your assets are, you're going to give the balances as of the day or the week, that you're filing the FAFSA. And unless you've got, several hundreds of thousands of dollars sitting in a non-qualified mutual fund or such, your assets are not the major thing for you to worry about. It's your income. Your income is the driving force of the percentage of how your SAI number is calculated. Your income can be anywhere from 22 to 47% assessed. It depends on your tax rate and such, your adjusted gross income. Your assets are assessed at 5.64%. So much less. So if your income is over, 100,000, I wouldn't worry too much about trying to move assets or hide them, shelter them, whatever. Should you be strategic with assets that you don't, your discretionary funds that you might have? Sure, you can. It's not cheating anybody, but just be aware that that's not the driving force for the majority of you.
Someone's asking, is RAP a repayment assistance plan?
Yes.
And what's
So
it
that's
for?
the new income-driven repayment plan that they are proposing. And what I like about it is it's not going to be, if you, income-driven means that you cannot afford to make that full 10-year repayment, standard repayment plan. So you need to have a lower payment. And so with this RAP IDR, which they're talking about, there's only going to be 1 or 2 different plans. And so with the RAP, everybody pretty much is going to be repaying their balance. It's just going to be drawn out to as long as 30 years. So it's like taking on a mortgage. And if you are not paying the full interest, each month. It's not going to get tacked onto your balance. So your balance isn't going to grow like it does today. And they're going to have payment tiers. So if you make less than $10,000 annual, doesn't mean as it stands right now, you'd have a zero payment. But now there is going to be at least, a $10 per month payment. And then it's just going to go up a percentage for each tier until you get to $100,000. And then, it's so it's going to get stretched out over that 30 years. So everybody would be expected to pay the principal amount, but they're not going to get crushed with all of that compounding of interest. That's working against them instead of for them.
Okay, well, thank you, Luann. It's about 10 to, 10 to 10.
We can't finish in a timely manner, Debbie.
Right.
So
Hopefully this was helpful to everybody.
I
Again,
hope so.
didn't mean to be scary, just want you to be prepared. As more information comes out, I am sure we will do many more of these sessions. If this is something that you are not happy with, again, there's still time, so feel free to contact your representative and your senator. But regardless, even if you do reach out to them, be prepared, because there's a good likelihood that if the bill gets passed, that variations of this are going to come down the pike. And the bottom line is there's going to be caps on borrowing. It's just going to be, how are they going to implement the caps? So I think that's the biggest takeaway for that you should understand for tonight, and really understand your family's budget for college, and kind of think worst case. What if you look at some of these caps here? What if that's all you can borrow, because you may not be able to get something from a private lender? So that should, you should be planning like that.
And can I just say, a lot of parents take this very personally, and they say, I feel like I've failed as a parent. I feel like a loser or such. I've really let my kids down. You haven't. It has nothing to do with you. It's just the system. All of these changes should have been implemented at least 15 years ago.
Or some variation of them. Yeah.
Yeah.
We didn't get to we didn't have to get to where we are right now.
No. But, I remember 15 years ago doing presentations in person, back in the old days. And, we would project out what to expect, in 5 years and 10 years. And, I look back at some of that information, I'm thinking, holy moly, we're on track. I never expected to see colleges that would cost
These prices.
$100,000 for
Yeah.
1 year of undergrad.
Yeah, I just did along that point. When I was just updating our own data, based, on from college data, and trying and looking up, because around about this time is when colleges start to publish their 2025 tuition numbers. I mean, don't mean to break the bad news to the families here with seniors, that just graduated. You haven't seen the tuition yet that you're going to be asked to
Nope.
pay, because a lot of schools don't publish it until July 1st. And and I was updating just information, for actually NASCAC schools. So kind of like those small liberal arts schools. And it was one after another. It was 90,000, 91,000, 92,000. Just like, what? That's
Well,
crazy.
I had that slide in there that showed that whole list of schools, and what they all had in common, they were all over $90,000, and none of them offered merit scholarships, just financial need-based aid. And, I looked at Miami, University of Miami today, and looked up for a parent who thought, they provided me the financial aid award. I said, I just Googled and they had an increase and it went from 93,000 to 97,000.
So
So
one last great question, and then
Mhm.
I gotta honestly get to sleep. But
Me too.
so
I've been up since
it's
4.
asking, do we think that there might be some benefits to these changes in potentially lowering college fees?
I think there will, but it's not going to happen overnight.
Right.
It just,
I think it might have happened a little faster if the only thing affecting colleges was this bill. The fact, quite honestly, that all these executive orders are also compounding the colleges. It's just hard for them to react and manage both things at once. So
Mhm.
I think they're gonna respond a little slower to changing their prices because they're dealing with all these other things.
Yeah. All I would dare say that the top, 100 that everybody seems to want to go to because it just, it's the top 100. I don't think they're going to make any changes for quite some time. But we have, well, we did have almost 4,000 schools in this country, and a lot of them are really great and affordable. But there's going to be a lot of smaller colleges that have already started closing and that will continue to close. And even some of these big systems like Penn State, they're consolidating a lot of their satellite campuses uh, because they've had lower enrollment the last couple of years. Everybody wants to go to the popular big one. So we're going to see a lot of changes over the next few years. Part of it is because of all of this, but also because there's fewer students that will be attending because there are fewer students that were born after 2007. So the senior classes are getting smaller and smaller.
Yeah.
Yeah,
Okay.
I'm,
Thank you,
I gotta
Luann.
get to bed.
Yeah, thank you, everyone.
Thank you for those of you that have stayed with us all this
Yeah,
time. So
and let's just
good
keep
luck.
sharing information and keeping our eyes wide open.
Yep.
Okay,
Oh, okay, Debbie, take care.
good night.
Bye-bye.